Well, good evening, everybody. My name is Jim Musgrave. I want to thank you for joining us on our market update call for tonight. And a lot of stuff is going on in the markets, and I'm going to cover a lot of that tonight. And so what I'm going to do is just kind of start off with some disclosure stuff. So this information contained herein is intended to provide general information only and should not be construed as an offer to specifically tailored individualized advice. Again, please contact your professional advisors for advice appropriate to your specific situation. And past performance may not be indicative of future results. Different types of investments involve varying degrees of risk, and therefore it should not be assumed that future performance of any specific investment or investment strategy will be profitable or equal to the corresponding indicated performance levels. Moreover, you should not assume that any of this content serves as a receipt of or as a substitute for personalized investment advice. Okay, so we got the disclosure stuff out of the way. So what I'm going to do tonight is I'm going to cover the markets that are just evolving rapidly. This is a presentation that I gave my clients on Monday, and I'm just going to give the same one to you guys. So some is going to have portfolio stuff that I'm doing with my clients, but you could also apply it to yours as well. We're also going to talk about rethinking your overall portfolio allocation. And also amongst this carnage of the markets, there are some opportunities. So we're going to kind of talk about that as well. But what I'm going to do, I'm just going to kind of break the PowerPoint, and I'm just going to go to a couple websites. And all this stuff is public information, and you guys have access to it. So the first one, there's a website called advisorperspectives.com. And actually, some of these slides are actually on the PowerPoint. And what my plan is to I got to submit the PowerPoint and the actual video that I'm recording right now to compliance, and as soon as I get that approved and everything's okay, then I will hopefully be able to forward that to you so you can watch this again and also look at the PowerPoint slides. So I first want to kind of point out this right here. So you can see the last trading days from March the 12th, which was last Thursday. The market dropped. This is the S&P 500 dropped 9.5%. We gained most of it back on last Friday. On Monday, the S&P dropped about 12%, which is one of the worst drops in stock market history. Yesterday, we rallied about half of that, and then today we lost it all. And that is just kind of where we are with the market. So what we find is that we are experiencing huge volatility, and it's just very, very difficult to see where the market's going on a daily basis. But the overall trend is down. Okay, so I'm just going to kind of hit this quick so you can see. Here's the S&P 500 dropping, and I'm going to get to more detailed slides in just a second, but you can just see the big negative candlestick. And what I like to show you right here is the perspective of the drawdowns. It goes back to 2009, and these are all the points where the market has pulled back. And I want you to notice right here in 2011 and also Q4 2018, you can see the market dipped to just under 20%, but you can see that it rapidly rebounded fairly quickly to get back to all-time highs, which happened in February of this year. And you can see we're down over 30% off the all-time highs in an extremely short period of time. It's like waking up in a twilight zone and like, where am I? And that's exactly what's happening right now. And you can also see the number of the days that the S&P has been in correction versus positive days. So again, S&P 500 number of days in correction, where the market actually was either up or down 1% or more. That's 13 days in 2020, which equals the same amount of days of all last year. And again, you can see the point right here from the overall S&P 500, the different pullbacks right here, and how things are pulling back at this point. And this is also a great slide just talking about the intraday price volatility. So we are up in this area right here, which is really close to where we were almost at the peak of 2008. So if it feels bad, it is bad, and the VIX is representing that pretty well. Okay, The other thing is that I just got this. This came out at 4:46 today that the New York Stock Exchange to temporarily close the floor, move to electronic trading after positive coronavirus test. So when the actual trading floor starts to close down because of the coronavirus, things are getting kind of hairy. And if you just go to CNBC, just to the main page, you can see the news. I mean, it's just happening very rapidly. So essentially what's happening is that things are crumbling in both the stock and bond markets, and the federal government is going to provide an enormous amount of stimulus in any way they can. So there's going to be, obviously the Fed lowered interest rates over the weekend. There's going to start another round of quantitative easing. And now they're literally talking about giving money to individuals as well as small businesses and large businesses. I mean, they're talking about bailing out or giving some liquidity to the airlines and all sorts of things. So again, you can I mean, all this information is available and you can kind of read it just as well as I can. One thing that I would actually watch if I were you is that this Bill Ackman is a huge hedge fund manager. He was on CNBC today and he was just kind of talking about his view on what's going on. It's pretty sobering. And what he's concerned about is the rate in which this virus has spread across the globe is staggering. And it's not over yet. And that's ultimately kind of what's causing all this turmoil. And let me see if I can get, the problem is that I got my little, okay, a couple other things too. Also, when you're kind of reading these things right here, you'll also see different ads. And I saw an ad for the Motley Fool where they've got a touchdown buy alert. And so if you guys are not familiar with the Motley Fool, they're a group actually based here in the DC area. But let me tell you guys, now is not the time to get a stock tip, okay? Just let me give you some advice. They're talking about, great, hey, Netflix did great and Amazon did great, but you know, this is not the time to catch a falling knife and buy stocks, okay? This carnage is not over with. Now is not the time to buy the dip. I don't know how more strongly I can say that. And here's just another chart that kind of just shows you how quickly this pullback has been. This big chart right here was the Great Depression in 1929. And you can see that this one is falling just as sharply, and then it kind of rebounded and kept on going. I'm not saying this market is going to do what we did in 1929. I don't think that's going to happen, but it just shows you how quickly the bottom has kind of fell out of the market. So I just want to kind of share with you just a few charts, you know, and just some websites that you guys have access to, just to kind of kick off the evening right here. So let me kind of move on. So this is the S&P 500, and I show this to in all my workshops and to all my clients. And basically, this shows you the S&P 500 of the last two bear markets. And you go back to 2000 2003, the S&P lost 49%, and it took 87 months to break even. And you look at just as it got to break even back in the second, third quarter of 2007, the last bear market recession started. The S&P lost almost 57%, and it took 65 months to break even. And if you can see the big rectangle on the side of my screen, excuse me, these are the different support levels. And so this was each one of these candlesticks, it represents a month. So you can see that we had a support level right here. It broke right through it. The next support level was right here, and that's ultimately where, anyways, that's another support level that broke through it. And we also have another support level that got to the bottom of the market back in last year. And anyway, so right now we are where we are in early 2017. So if you are in a buy and hold portfolio and you or your broker has taken the approach of the buy and hold mutual fund pie chart, this is where you are. Okay, you've basically kind of given up most of the gains that you've made since 2017. Okay, and not only is the stock market getting hurt, you also have the bonds. And so what we're seeing right here is just a complete disarray in the bond markets. And just to keep it simple and in English, what's happening is that as the Fed reduces interest rates, it's causing all sorts of gyrations in the bond market. And what's happening is that there are more sellers than buyers in the market. And so what the Fed is trying to do is introduce liquidity into the market, and that's causing all sorts of kind of issues. And so ultimately, it's hard to find the real value of the bonds in the markets right now. So what you're going to see is that the actual ETF version of the ag or different bond sectors is a little bit more accurate in terms of the true value of that sector. What you're going to find is that the net asset value within a mutual fund, that is not necessarily an accurate representative of the net asset value of the funds. That's going to ultimately catch up with them in the near future. So what I'm saying is that you have to be super selective with what you own in both the stocks and bonds in your portfolio. So this is a chart that's old. This came out last Friday, and you can see as of last Friday, the sectors that have held up the best are consumer staples and healthcare and technology. And the ones that are really getting hurt are obviously airlines, energy, and hotels. And I'm going to get a little more into energy in just a few minutes. But you can see that the areas that are getting hurt right now are the ones that are going to be vulnerable to basically quarantine and people not going out. And I think what the market is, and people are realizing, is that no matter how much federal stimulus that's out there, and no matter how low the Fed is going to lower interest rates, you and I are not going to buy a ticket on a Carnival cruise tomorrow. Okay, this is lower interest rates is not enough to get us out of the house and spend money on a vacation. Okay, and I think that's what the market is waking up to, saying, hey, you know what, things are going to get worse and deeper before they get better. So that's kind of what's going on right there. And again, this is what I just went over with you. You'll have this as a copy in the handouts. Again, I love to show this. This is the emotions of investing, and many of you have seen this before. And what we saw from October of last year until the third week in February of this year is that the market just had a nice smooth ride. Everything's going well. People were putting money into the market. All is good. And then boom, like a rock, things start to change. And now we're kind of into the panic-stricken mode. So what do? Your people are getting mixed signals on what to do with their portfolios. I want to share with you some of those ideas that I have. But again, we're certainly to the point of being panic-stricken, but I think the panic in this case is justified. So again, these are some of the charts I just went over with you. Another one I go to, I think I've showed a bunch of you before, is if you do a Google search for anatomy of a recession, ClearBridge Investments will come up, and this is their little snapshot. So this is as of the end of February of this year. So it's only 2 weeks ago, and you can see that in February, we're still in a cautious kind of posture. The things that are doing well in terms of financials are credit spreads and money supply. But really what's held up the markets has been the consumer. And you've seen housing permits doing well. The jobless claims are still really low. Retail sales at this point, we're still doing well, but I will show you retail in just a minute. It's getting crushed right now. So we are not in a recession at this point, according to this chart. But the reality is that we actually are in a recession, and I'll kind of show you some other things that kind of prove my point. So actually, before I do that, I want to just kind of read a couple things. So I've been on multiple conference calls with institutional managers that are managing billions and billions of dollars. And the one I was on yesterday was with Jeff Gunlock at DoubleLine, who's the bond king, and basically what he was just kind of talking about was that, again, that the Fed is buying bonds, and again, just to do with normal market forces, we're going to see the long end of the curve. That means the 30-year bonds actually kind of steepen. What's getting hurt right now are corporate bonds, and and your high yield, because I mean right now in this low yield environment, everybody's looking for yield. So those are actually the areas that are getting hurt the most. Again, the people that are being laid off are the people in the hotel business, the restaurant business, the travel business. So those are getting hit first, and then that's going to kind of filter into other sectors. So, when you think about it, if you take you and me out of the public buying goods and services, and I think Trump was talking about yesterday that this may be going on until mid-late summer. So what I'm concerned about, and I think what the market is concerned about, is that small businesses may not make it, and that's why the Fed is trying to get cash into people's hands, so this situation kind of can get into control. So anyway, so that's the main thing. The second thing that we have going on is a shock to the oil supply, which I'm going to talk about in a few minutes, and but basically, kind of going back to things, what the market is doing, what the government is doing, is that they are basically buying back bonds, giving people money, and what that's ultimately doing is it's adding to the deficits. And Mnuchin is saying, hey, we shouldn't worry about deficits right now. We need to get cash in the hands of people. Well, I disagree with that. We're already on an unsustainable path in terms of our federal deficits, and this is just pouring gasoline on the fire. So that's a little bit what's going on right here. So talking about mixed signals on what different sources will tell you. They said, hey, listen, hey, we're going to go through recession. We've had, now this is our 17th recession since the Great Depression. Just stay the course, everything will be fine, and the market's going to eventually rebound. Well, all that is actually true. That the problem is that your portfolio is just going to drop in the meantime. So this is a chart that says, hey, if you stay invested, talks about on the left-hand side, the top 20 quarters of capital invested, then the orange is a 1-year return, then a 3-year return after that. So yes, as history shows, that we tend to be in positive territory after a bear market. We all know that. And again, you can see the top 20 quarters of capital, cashed over a 1- and 3-year period. Yes, we're going to be up. So you can certainly take a buy and hold strategy. Just be aware, or you just have to, understand that your portfolio will continue to drop and drop and drop. And the problem with that is that the further your portfolio drops, the higher the percentage that you need to get back to break even. So if you lost 10% in your portfolio, you need an 11% rate of return to get to break even. But if you lost 50% in your portfolio, you need a 100% rate of return to get to break even. Right now we're at -30 on the S&P. So right now, if you're 100% in stock, you need a 43% rate of return to get to break even. That's the problem that we have. That's the problem that I have with modern portfolio theory and buy and hold, because as I showed you in that slide, it took 65 months for the S&P to recover and from the last recession. And most of the people on this call don't have that time to make up for those losses. So one of the things that most of you are hopefully doing is that you're not 100% in stocks. Okay, so what this shows you is that if you're back in in 2000, over a 2 recession period from 2000 to basically 09, and you're in 100% S&P 500 portfolio on the left-hand side, you can see the drop of -47, then it comes up, and then it drops 55 in the last recession, and then on 12/31/2018, your $100,000 portfolio is up to 236. But if you have a portfolio that's 50% stocks and 50% bonds, you can see that the drawdowns were much lower, -23, -27 versus -47, -55. So over time, you ultimately will have more money because you have fewer drawdowns in the portfolio. So, but that doesn't, you're still going to have drawdowns if you have a 50-50 portfolio or 40-60 or 60-40 or whatever. You're just not going to drop as much. But it just shows you that there is the huge benefit to being, again, in a balanced portfolio. And so again, I keep on talking about modern portfolio theory, and the reason why is that most of the financial industry and many, I don't know the percentages, but I would say it's probably well over 70% of all the financial advisors out there have drunk the modern portfolio Kool-Aid. And in fact, that all of the target date funds that are in your 401ks and TSPs are based on modern portfolio theory. And just by definition, again, you can go to Investopedia and look at the definition, but it's a theory on how risk-averse investors can construct portfolios to optimize or maximize expected return based on a given level of market risk, emphasizing that risk is an inherent part of the higher reward, okay? So according to the theory, it's possible to construct an efficient frontier of optimal portfolios offering the maximum possible expected return for a given level of risk. And this theory was pioneered by Harry Markowitz, and you can read his papers and so forth. Again, this is kind of what the industry has adopted, whether you are Vanguard or Fidelity or Edward Jones or any of the brokerage houses that are out there. This is kind of what they say, hey, this is what we believe in terms of our investment philosophy. And we're going to find that the target date funds, the robo-advisors, the asset allocation mutual funds they're based on more modern portfolio theory. The reality is that it has good intentions and it aims to create the most return for investors while honoring their risk tolerances. But let me show you something. The disadvantages is that it does nothing to minimize losses in a bear market. And they're generally not tactical and do not account for changes in the market, which I'm going to show you in just a second. And again, it's still common to see mutual funds and variable annuities with high expenses also taking the modern portfolio theory approach. So this is what I see all the time. Again, I've met with a lot of you on the call, and I see roughly about 12 new people a month. And I see this over and over and over again, is that people have a portfolio filled with mutual funds, kind of based on this modern portfolio theory, and there's many portfolios just haven't been rebalanced in years. And it's tragic, but I see it all the time. So again, I gave this presentation to my clients on Monday. I'm just going to tell you what I did. I'm not necessarily making this recommendation for you. But what I did was that for my clients, including myself, who are in an aggressive growth or a growth portfolio, I've now gotten more defensive down to a 60-40 portfolio. And for my clients that have got a 60-40 or a 40-60, they're currently in a 20-80. So my more conservative clients, or actually most of my clients are in a growth and income portfolio. And so the majority of my clients at this moment are actually in 20% stocks and 80% bonds at the moment. Okay, so what I want to kind of explain to you is why that's, why I'm doing that, and also by the definition, what is a black swan? Okay, a black swan event is an extremely rare event with severe consequences. It cannot be predicted beforehand, though many claim it should be predictable after the fact. It's like, oh man, Jim, you should have gotten out sooner. You should have seen this. Man, I saw it a mile away. Well, no, you don't see it a mile away because it's unpredictable. Okay, no one could see this coronavirus, and no one could see the falling out of Saudi Arabia and Russia with the price of oil. Okay, that was something that no one could see. Okay, so the reliance on standard forecasting tools can both fail to predict and potentially increase vulnerability to black swans by propagating risks and offering false security. Okay, so again, what I talk about within my retirement income planning is being able to deal with the black swan events. And what we're seeing, that we're all experiencing today, is a black swan. Okay, let me see if I can get this going. Okay, so some examples of the black swan events are the financial crash in the U.S. housing market in 2008, the dot-com bubble in 2001. And again, in all these cases, Americans were enjoying rapid economic growth and increases in private wealth before the economic catastrophe finally collapsed. Okay, and that's exactly what happened in the last year or so. Is that things were kind of smooth sailing, and then boom, things happened. Okay, so we are in a perfect storm of a black swan event. We've got a three-pronged black swan. One, the coronavirus. Two is the oil price war, and three is that we're also in an election year, which adds some uncertainty, but not nearly as much as the coronavirus and the oil price war. So these are just kind of slides that, quite frankly, they're out of date. You know, I'm not going to spend much time on this because you guys are already aware of what's going on with the coronavirus. Bottom line is that it continues to spread throughout the world. And again, I mean, hopefully that we can bend the curve so it doesn't go as steep. But and again, it's going to get worse before it gets better. So hopefully it won't, you know, get too bad. But that's certainly a possibility. What I'm concerned about is if you look on, there's a percentage of our population who are homeless, and they're not going to get the care, and they're not able to, you know, kind of protect themselves as well as maybe you and I can. So I think there are pockets of our society that are more vulnerable to this just by the conditions that they're in. So, you know, we just don't know where things are going. The second thing I talked about was oil. Okay, this is so so let me point this out. If you look in the upper left-hand part of the screen, you're going to see the sectors of the S&P 500, and all I did was rank them year to date. So utilities are the best performing sector of the S&P 500 year to date. It's only down negative 19.71, followed by communication services and consumer defense, healthcare, technology, blah, blah, blah. But the worst one you can see is energy, where as a sector as a whole, year to date, you're down negative 61. And the little section below that says industry indexes breaks down the different types of the energy. We got oil and gas, you know, integrated, refining and marketing, and so forth. But you can see the oil and gas drilling has taken the worst hit out of everything. Because again, essentially what's happening is that the price of a barrel of oil is well below $30 a barrel, and that's well below the price that it's profitable for companies to actually drill for oil. So that's essentially who's getting hurt the most, is in terms of the oil drilling companies. And then when you actually break down that sector, you can see the individual stocks right there. Again, it's just a snapshot. Those are the best performing ones, but there's 319 stocks that are doing much worse. But if you look in the upper right-hand corner, you can just see energy as a sector, again, peaked in early January, and it's just fallen off the waterfall. It's just very difficult, and I just don't know how long it's going to take to get back to some sort of normalcy in the markets right there. Okay. So, and the third thing we talked about in terms of black swan was the you know, the uncertainty of elections, and so this kind of goes back in history in terms of the election years. What historically has the S&P done? And again, if you look at the election last year, you can see that the market, it's not in this chart, but I remember this very clearly when it was Trump against Hillary. Ultimately, the market was certainly uncertain for Q3, and it was certainly down 5 or 6%. And then Trump got elected. The market anticipated lower taxes and less regulation, and we kind of start off that bull market in 2017. So right now, you know, we'll see what's happening. It's really interesting to see the difference, how the Democratic convention is and how people are debating that. So it's going to be an interesting watching this, you know, the debates moving forward. So in my invitation, I sent you 2 links to a couple reports. Both of them are from BlackRock. You can actually click on those links and download the actual PDF file. I just took a handful of slides right here to kind of show you some things. So again, go to the email I sent you that had the link to this webinar, and you can actually click on the links and download these reports. But what this is showing you right here is that up until very recently, you can see that the economies, although they're kind of starting to drop a little bit in terms of GDP in 2019, they actually had an uptick in you know, 2019 and 2020. So things were actually going reasonably well, although again, the overall GDP growth in terms of US, the Euro area, Japan, and the United Kingdom have kind of been muted since 2018. Again, this is all in the report, but again, the overall macro, again, this is through BlackRock. Basically we see the coronavirus outbreaks and containment measures causing near-term disruption in global economic activity. This may push Japan, the euro area, to the brink of technical recession. The U.S. will likely prove more resilient. We expect a recovery in activity, once disruptions dissipate, but their depth and duration are highly uncertain. This could weigh on consumption and investment. Implication, we downgrade our moderate pro-risk stance and turn neutral on equities. Okay, so this came out a week or so ago, and again, I'm on daily calls with BlackRock, and they're certainly very much aware of the deteriorating conditions. But again, what we've seen right here is that the Federal Reserve has delivered an emergency rate cut, and we see more rate cuts to come. And basically, we're just going to see lots of fiscal stimulus, thrown at it. I think it may not be enough to kind of put out the fire, but it'll hopefully help a little bit. In terms of rethinking resilience, again, our preference for U.S. Treasuries and Treasury inflation protection securities as portfolio ballast work during the recent, virus-related equity volatility. And the moves confirm that some developed market bonds offer less diversification with yields near levels we consider to be at their lower bounds. So a focus on sustainability will help make portfolios more resilient. So again, we prefer U.S. Treasuries over lower yielding peers as portfolio ballast and see a strong case for integrated sustainability in investment processes. So let me kind of explain to you what they're saying in English. Historically, the reason why you have bonds in a diversified portfolio, whether it's a 50-50 stock to bond or 40 or 60-40 or whatever, is that bonds did two things. One is that they provided a good amount of yield, and the second that they offered a shock absorber when equities dropped. The problem is that as the interest rates continue to drop, the yields are not there, so it's very, very difficult to find yield in fixed income, and you're forced to go out to risk your fixed income asset classes such as high yield bonds, double B, triple B types of paper that yes, you can get a higher yield, but you're also taking on considerably more risk. So essentially, where bonds are fitting more in the portfolio right now are more to minimize losses when the markets drop. And what we're also seeing, and again, I just want to kind of show you this real quick. Just want to kind of go to my charts. What you see right here on the left-hand side, these are not my core positions, but they're core positions. And what you're going to see is that the ETFs that are doing reasonably well are in the fixed income. And so what you see that's been doing well is the TLT, the 20-year Treasury. Although we've seen a bit of a drop, this is due to the lack of liquidity right here. We've also seen government treasuries. Again, we've had a nice little run, but again, what we're seeing right here is the lack of liquidity in the bond market and the reason why things are dropping. But what I want to show you right here, which is really what's getting crushed, are corporate investment grade bonds. So LQD is the iShares, corporate bond. LQD was down 5% today. So if you actually look at just mid candle to right here, actually you can see right here that corporate intermediate bonds, again, this was down 13.64% year to date. We also see that short duration high yield corporates were down 14.71. Okay, these positions that we had right here were actually doing very, very well up until very recently. If you just look at January, I just put a line right here, we've had a really nice, beautiful run. So in normal circumstances, we have these are great positions in a portfolio, but again, in extreme times like that, they can get hit. So, these are things that you have to kind of look for in your portfolio. Is that what percentage of corporate bonds do you have, or are you willing to hold this and have it potentially go down, down, and down, or do you want to get more tactical and not own those in your portfolio at this point? So what I'm illustrating to you is that you've got to be very, very selective with what you own in your fixed income portfolio. Again, treasuries have held up pretty well. They're up 4% year to date. The TLT, the 20-year Treasury, Also, short-term treasury bonds are hanging in there very, very well as well. So, I mean, right now, you're not really buying bonds to get any kind of yield or interest. You're basically buying them as a protection against the downside. In a few minutes, I'm also going to talk about ESG, or sustainable investing. And I want you to look at this for a second. The AGG is the aggregate bond index. This is a diversified bond index made up of multiple different fixed income asset classes. AGG is down negative 5.16 year to date, but the ESG version is down negative 1.5. So what we're seeing here is that ESG positions in both the fixed income as well as equities are outperforming the normal ones. The second one right here is that if you go to SUSA, that's an ESG S&P 500 type of ETF, down 22.6 versus the SPY, or the S&P 500, down 25. So there's about a 3% difference right there in terms of the ESG version of the S&P 500 and the actual S&P 500. So I just want to kind of show you that while I'm on the screen at the moment. Okay, moving on. Let me go here and here. So as I showed you at the very top of the presentation, volatility has spiked in both equities, treasuries, and crude oil. We also see that the future GDP is expected to decrease. Okay, this is fairly obvious when everybody's quarantined and is told not to go out into bars and restaurants. So we're going to see it definitely slow down the economy, and this is a very obvious thing. And you can also, what I like about this slide, it kind of shows you that, again, this kind of started in China, and it first started off as a demand issue, but has now turned into a supply issue. So the problem is that if you have a company in Japan that was producing one part that went into an iPhone or into the little pump thing that goes into a hand sanitizer, that means Apple can't get that part to sell their iPhones, and the companies that sell the hand sanitizer can't get that part to produce that and to get you more hand sanitizer out in the supermarkets. So what happened is that these parts were not being produced, therefore other companies couldn't get them, and therefore they can't get their goods and services out to you and me, and therefore their earnings drop and their stock drops. That's the short connect the dots train of thought on what's kind of happened with the supply and demand of the products and companies producing goods and services. What you can see right here is that the United States hasn't been horribly affected negatively compared to other countries. Singapore, Vietnam, Thailand, South Korea have been certainly hurt harder economically than the United States in terms of their manufacturing and GDP. Again, what I talked about was the resilience of the consumer. Up until this point, the consumer's been doing really well. What I'm concerned about, I think what the market's concerned about, is that the consumer sentiment is going to drop. And again, this is where we are right now. The current unemployment rates are fantastic. I mean, that is exactly what you want to see in the jobless rates. Okay, but the problem is that this data is a little old. So what you're going to find is that when the ADP report comes out in terms of the unemployment rate, we're going to see that inch up month after month after month until this thing is over. And that's what I'm concerned about, is that the unemployment rate is going to continue, and that's when things are really going to be hurting for families. And so we have to watch the consumer very, very carefully, because that's going to be an indicator on how the markets behave. And again, you can see right here that the banks are doing everything that they can to throw liquidity in the market, lowering interest rates. It's not just the Fed, it's the BOE, the BOJ, and the ECB. And again, so what we're seeing is very historically low rates. You can see the ECB has actually gone to negative interest rates. I don't see that happening here in the United States, but you never say never. So it's just kind of a scary time in terms of monetary policy. And basically, remember what happens is that when we get into a bear market recession, as we did in 2000 and also 2008, the Fed typically lowers interest rates to boost the economy. The problem is that we cut the interest, or the Fed cut the interest rates in the last recession, and they didn't raise them fast enough, and we got used to very accommodative, cheap money, and now we don't have as much ammunition to deal with this recession as we did back in 2008. So that's going to be an interesting situation moving forward. And again, we talked about more physical stimulus on the way, and that's what we're seeing across the board globally. And this should help. It should help things a bit. I just don't feel it's going to be enough, and we'll see what happens. And so when it comes down to the actual allocation of the portfolio, well, actually, let me kind of explain to you what this chart is. Since December 6th to January 17th, in the orange on the right-hand side, these are different sectors that had positive returns. So Asia, ex-Japan, emerging markets, U.S. equities, global equities, European equities, emerging markets debt, they're all in positive territory. All these sectors were doing really, really well up until January 17th. But since January 17th, you can see to March the 10th, you can see the negatives in these different asset classes. And just, you can see that your equity is down nearly 20% in that period of time. So you can just see how quickly things have kind of turned around. So, and again, this is just another thing what I was talking about is that earnings revisions are likely to take a hit. So what we're going to see is a downtick in terms of the earnings of various companies, and that's also going to hurt stock prices and hurt your portfolios. Now, I'm going to get into a little bit of portfolio construction. I want to contrast what the typical buy and hold investor and what the typical, Edward Jones and, I don't want to point out names, but these typical brokerage houses that are into modern portfolio theory, what they're doing versus what institutional money management is doing more of on a tactical approach. So again, I tend to use the BlackRock stuff. I'm not promoting this. I'm not saying that you guys need to go with BlackRock. I'm just giving you an example of what large institutional managers are doing in contrast to modern portfolio theory buy and hold investors, okay? In markets like this, there are opportunities to, and I make this analogy. You have a bond portfolio and you have a stock portfolio. And in both of those portfolios, if you think about putting your right foot on the accelerator in your car, you can put the pedal to the metal and actually be more aggressive, or you can actually let the gas up and be more defensive. So right now, it's time to be defensive. And so essentially, what can you do if you still want to have equity exposure, but you want to reduce your exposure to losses? Well, first thing that you can do is that you can buy higher quality positions and not buy the entire U.S. stock market. Okay, so being more selective with what you own is certainly a great option. So we own a lot of high quality stuff right now. Second thing is that what you may or may not be aware of is that there are minimal volatility ETFs that will basically buy companies that have less beta, or they're less volatile than the market as a whole. So essentially, we have been overweighting minimal volatility ETFs opposed to momentum. And momentum is another thing where when you really have a positive momentum, you can actually put a portion of the portfolio in momentum that will actually be a little bit more aggressive and take advantage of some of those positive market swings. Okay. So, and we also talk about the fixed income portfolio. What we also like about TIPS, or Treasury Inflation bonds, is that again, we are going to see periods of inflation, and so by kind of having some degree of TIPS in the portfolio, that's going to kind of help against inflation quite a bit, and also that's going to help again when growth stocks take a big hit as well. So again, one of the things that we're also going to be hit with, not only a drop in equity prices and bond prices, but we're also going to see inflation kind of creeping in. That's another thing that we also have to address. So again, this was a presentation for my clients. So again, this is a little, I guess kind of directed to my current book of business, but One of the reasons why I use BlackRock is because they literally have over 135 teams globally. And essentially what they're doing is each one of these teams is monitoring a sector of the market. And literally every month in New York, they get together and they talk about sort of the baseline and where we should be, and ultimately make allocation changes. So again, I'm not promoting BlackRock, but I think it's important that whoever you work with needs to have a good, solid I guess, resources, and have a world view of where things are going. Because again, where the institutional money managers have an advantage over the buy and holds is that they're able to interpolate the economics that are out there and have a world view and say, okay, it is likely that this is going to happen. Therefore, we are going to position the portfolio in these areas to take advantage of that, or we're going to underweight the portfolio in these areas to minimize the I guess the risks that are out there. So again, where we look at is again, you got you, the client, you got the financial advisor, and what BlackRock is doing is that they're providing, at least me and my clients, a lot of portfolio guidance and a lot of the intellectual capital to look at that. And again, just across the board, again, this is a good time for you guys to be monitoring your own portfolios, is that there's been a lot of fee compression out there. So, I mean, the average expense ratio in my portfolio ranges between 15 basis points and 25 basis points. If you guys don't know what a basis point is, there is a 100 basis points of 1%. So the ETF portfolios that we're doing are extremely low, and again, we can bring costs down as much as we can. That's advantageous for everybody. But it's not, having low cost in your portfolio is not enough. You actually have to have the investment strategy, and you have to be tactical in order to take advantage of that. And so I love Vanguard. Vanguard's a great company. I own a bunch of their stuff. But the problem is that the Vanguard story is that they've told people that low fees equals no risk, and that's absolutely not the case. Okay, so essentially, when you're looking at institutional money management, they're going to be tactical. And again, this is what I firmly believe in, is tactical money management versus buy and hold. And so we get trades quarterly, and sometimes even more frequently, depending on when the markets are happening. And so when we make subtle changes in the portfolio, there's a reason why. So for example, today I sold 3 different corporate bond ETFs because we're seeing a huge drawdown in corporate bond ETFs. And so that's an example of kind of what we're doing proactively in the portfolios. And just kind of give you an idea, again, this is as of March, the areas that we're overweighting and underweighting. You can see that we're underweighted Europe, or overweighted Japan and emerging markets. In terms of momentum, we're kind of neutral. We're underweighted value. We're kind of overweighted minimal volatility and quality. Treasuries were neutral, but we're underweighted the German bond, euro area peripherals, and also global investment grade corporates. Again, up until this point, global high yield, emerging market, hard currencies, and local debt was overweighted. My guess is that we're going to see a bit of a pullback on that. Now, again, this is a good time for me to kind of bring this up. Although things are tactical, you still have to you have to understand, what is your time frame? Are you looking the next month or quarter, or are you looking in the next 6 months or year or 2 years? So if you have a slightly longer time frame, then it makes sense to kind of hold these asset classes, even though if they're dropping in value right now, because again, this bear market's not going to last forever, and then when things kind of come up, you're going to be in decent shape. But the reality is that the average investor has no idea what's going on, and you need a true professional institutional manager to be able to understand and interpret which areas that should be overweighted or underweighted. And so I'm going to kind of move on a little bit to ESG right here. I kind of mentioned that a little bit in the beginning of the presentation. And ESG stands for basically environmental, social, and governance. And it's just a way that investors can invest and align their investment decisions with their personal beliefs. And what we've been seeing is that the number of assets under management going into ESG ETFs and mutual funds has just exploded. And I started getting to work ESG into my portfolios in the last couple of years, and more is actually going into ETFs. As I just kind of showed you just a few minutes ago, if you look at SUSA, we're down 22.62 versus the S&P down 25. And what I showed you before is that you have the ag, the bonds down negative 5.1, and the EAG down 1.51. So not only, I guess my point right here is that this is just a small little snapshot, but my point with this is that it's not only investing with your conscience and your beliefs, there are reasons in terms of performance that make ESG very compelling. So more ESG has been integrated into our portfolios and will continue for years to come. So just to kind of explain to you, like, what is, ESG? Again, it stands for environmental, social governance. And again, you guys are going to receive the slides, and so you can kind of read a little bit more on this. And I got plenty of white papers I can send you if you guys have interest in this. But essentially, there's just different types of ESG investing. There's ESG investing, which evaluates the companies based on their environmental, the social, and governance business practices to identify risks and opportunities. For example, selecting companies with higher ESG performance across the broad market exposure, just like what I just showed you. Another area could be thematic investing, which focuses on a particular environmental or social or governance issue, such as targeting clean energy companies or companies promoting gender equality. So in my ESG portfolio, I've owned clean energy for quite some time and it's done very, very well. Again, screened investing eliminates exposure to companies and sectors that pose certain risks to violate the investors. Again, it could be screening out companies involved with fossil fuels, firearms, or tobacco from the portfolio. And finally, impact investing seeks to achieve measurable, sustainable outcome along a financial return. So investing in green bonds that finance environmental projects like solar panels. So these are just examples of ESG and how you can own these types of things in your portfolio, do what's great for our society and the environment, but also it pays off with the performance in your portfolio. And just to give you an example, this is just a little bit of a history of the BlackRock. Again, I'm not promoting BlackRock, I'm just giving you an example. You can see that on the right-hand side, a 40-60 portfolio, a 60-40 and 80-20 or 100% equity. These are actual ETFs that you can own within your portfolio to actually cover the broad market, do well, and also have a 100% ESG portfolio. And again, over here, in terms of thematic ESG, I currently own ICLN in my portfolio. Check it out. It's a good global clean energy ETF, and it just kind of gives you an example. So, but you can buy global low carbon and also just global sustainable impact, SDG. So again, these are just some tickers to check out. But again, there's many companies that offer these types of investments. And so again, I would also suggest you check them out as well. So, and what you find is that people in their 50s and 60s and 70s, it's like the ESG thing, I get, I got a handful of clients in them. It's interesting. It really hasn't caught on that much, but the people who have really bought into this are the millennials and Gen X. So what you're going to see is that the people who are younger than us demographically are going to, again, they're already diving, into ESG pretty heavily, and we're going to see that continue, and we're going to see more and more ESG in 401k plans and other investment lineups that we see that are out there. So just to kind of recap the markets, I know this has been going on quite some time, but there's just a lot of cover today. So again, historically, the corrections of negative 19% or less bounce back within 3 to 6 months. And the bear market between 2000 and 2003, it took 87 months to break even. And back in 2008, it took 65 months to break even. it is possible that this could be another 2008. I don't want to be an alarmist, but at the rate things are going, that is an absolute possibility. That's why I'm getting more defensive with my clients, and you may want to consider doing the same. But again, by not investing, again, there's a flip side to what I just said. I got to be fair and balanced about this. By not investing when the markets start to come back, you miss out on valuable gains that will hurt your performance on the way back up. Okay, so if you're not using a program like I'm using with TC2000 or Thinkorswim or some sort of technical analysis software, and you actually have been through courses and you understand entry and exit points in terms of your portfolio and trading, it's going to be very, very difficult for you to time the market when get in and out. So this would be a, this is where taking a longer term approach may make sense for you, because the chances of you actually timing the market bottom is very, very slim. Even for professionals, it's impossible to predict when the bottom is going to hit and when things are going to start to recover. So again, given the historical probabilities of corrections, historical volatility, and proactive tactical institutional money management, again, I made the decision not to sell up to. Basically the S&P broke support at 2740 on the SPX. That's when I got to more defensive. Coulda, shoulda, woulda got out sooner, but I have to look at the charts and I have to be disciplined. And again, by getting out too early, historically speaking, you miss out on the gains. So this was a black swan event, and no one could have predicted it. But at least with my clients and my personal money, I decided to get more defensive about a week ago. And again, as of Thursday, March the 12th, as a matter of fact. Again, I'm just telling you what I did with my clients. And again, so the other thing is that the consensus that the markets are going to most likely fall until the coronavirus is under control and the prices of oil stabilize. The Federal Reserve lowered interest rates to add liquidity to the market, and this should help. But there is only so much the Fed can do, and don't expect a miracle. And again, the current allocation will remain until the market hits the support level and begins to positive momentum. And again, when I start getting back into the market, it's going to be more gradual. I'm not going to do everything all at once. Again, this is a presentation that I gave to my clients on Monday, so I'm just kind of repeating to you what I repeated to my clients on Monday. Again, in terms of the portfolios, and this is what I do want to kind of point out, because I want you to take what I'm going to share with you, what I'm doing in my portfolio, to contrast with your portfolio to see, and you're ultimately going to have to come to decide if you want to stay on the same path that you're continuing on. So, again, I have a phenomenal resource that, they're providing economic commentary and insights. What BlackRock gives me is the ability to provide multiple different types of portfolios, whether they're tactical, ESG, tax-aware, income models. There's a lot more, but those are the 4 that I'm offering at this point. Very low expenses. I said the average portfolio expense ratio in my portfolio is between 13 and 25 basis points. Tax efficiency, and again, good overall performance. The other thing that BlackRock gives us advisors is that I have the ability to do a portfolio stress test on your portfolio. So if I literally had your statement and able to plug in the tickers of a particular account that you have, I could show you how your portfolio is going to hold up over 30 different economic events that could happen. And the other thing too is that so I've got a lot of people who are kind of fed up with their situation, and they're moving the money to me. In non-qualified accounts, I use a third party called 55IP that I use to transition new clients from their current positions in taxable accounts to my models. And essentially what 55IP does is that they actually give me monthly trades on specific accounts that I'm trying to make that transition. And ultimately, when it's all said and done, they add between 1 and 2% of tax alpha or performance to that versus just selling everything and kind of guessing what happens with short and long-term capital gains and losses. So we actually use a professional third party to actually transition portfolios in non-qualified accounts to us. And also the other thing that what I'm able to do that others may not provide this option is actually the flexibility on what you own. Yes, I use the allocations that we have right here, but if you have positions in a particular account, let's say it's a UIT or an individual bond with a 6% coupon rate from 10 years ago, you don't want to sell it, we can move that money over and actually not sell that position. It just becomes a part of your portfolio. So what we're able to do over on my end is provide institutional money management, but also with the scalpel, so I can actually cut out the positions that you want to keep them in the portfolio. Then we kind of monitor them and see whether you want to keep them or sell them over time. So I think that's super important. The other thing is that one thing that I'm doing for my clients is adding an additional level of value in transitioning between offense and defense. And so again, I'm using the BlackRock models, but they're basically kind of doing their transitions quarterly. What I did today was I sold 3 corporate bond positions that were in the portfolio to actually make my fixed income portfolio less risky. And then we're going to monitor this stuff and get right back in. But until things start to calm down, I'm doing everything I can to minimize losses in the fixed income portfolio as well. And again, ultimately, with my entire book of business, I've got to make a judgment call for all my clients when we transition from offense to defense. Again, I got some clients who want me to be more defensive before another client, and then another client may say, hey, I don't want you to sell it all. I just want to kind of ride this out. So ultimately, what I do is that if my clients have a very specific thing that they want to do, just let me know about it, and we can make adjustments on your particular portfolio. But the bottom line is that I manage well over 200 accounts, and I have to make a judgment call what's best for the overall portfolio in terms of being offense or defense. And again, this is for my clients, but again, if you feel uncomfortable with the drawdowns in the market, just send me an email or give me a call and we can talk about that. And I'm just going to spend another 10 minutes just kind of talking about overall portfolio stuff. So again, I'm an RIA, I'm a fiduciary money manager, and I understand investments really, really well. But I also want to point out the fact that there are other ways to constructing your portfolio that do not involve money management, okay? So before I get to that, you can see that depending on your age, your portfolio could kind of transition to gradually a little bit more conservative as time goes on. So the most people on this call are either in retirement or very close to retiring, and I've talked about this in my variety of different Social Security and my retirement income courses. But there's 3 different ways to receive income from your portfolio in retirement. One is what we call the probability based. 2 is the safety first approach or the flooring approach, and 3 is the combination of those 2. So I'm going to talk about these 3 different philosophies very, very quickly, just to show you that having a good money management is not enough to make sure that you're going to deal with all the risks that we're all going to face in retirement. Okay. So what the probability-based approach is the investment-centric approach, okay? I've talked to a number of people here on the call about retirement income planning and using the foreign approach, and the decision was not to do that, and we're going to rely on the portfolio to take distributions, okay? So by taking distributions from your portfolio opposed to using insurance products to generate income. Again, the philosophy here is those favoring investments, the probability-based approach, rely on the notion that while the stock market is volatile, it will eventually provide favorable returns for most retirees and will outperform bonds. This is true over time. The upside potential of the investment portfolio is viewed as so significant that insurance products are not needed. Okay, so there are a lot of people, probably the majority of people out there are kind of believe in the probability-based or the investment-centric approach to taking out retirement income to fill the gap between your monthly needs and what your Social Security and pensions are kind of covered, okay? And essentially what you're doing visually is that you're taking money out of the risk tank on the left, you got Social Security that's coming in, maybe a pension, and again, you're going to be draining the investment tank to support your lifestyle. And again, we've got the safety tank right there. Will hopefully be some cash, maybe some cash value life insurance, or maybe like a fixed or indexed annuity. The probability-based approach is also, yeah, so anyway, the negatives to the probability approach is that you've got significant market risk like we're experiencing right now. And the other thing is what we call sequence risk, which I've talked to many of you already, and but I want to kind of go over that in just a second. The second thing is virtual liquidity versus true liquidity. And again, with the investment-centric approach, there is no guarantee that your portfolio will generate enough income to meet your expenses for your lifetime. So what I want to talk about a little bit is about sequence of return risk. And again, all it is that the sequence of return is the order in which you receive returns in your portfolio in retirement and why that matters. And what I want to show you right here is that let's say you had $1 million portfolio, you were 66 years old, you had a life expectancy to 91, you're going to take out 4% of your portfolio, and you got a 3% inflation rate, and let's say you're 100% of your money is in the S&P 500. What we're going to do is we're just going to use a 20-year period from 2000 to the present. So what you're going to see is that if we actually go back 20 years, and if you look at the bottom number on the green side right here, it says $1 million. And if I hit this little shuffle thing, you're going to see that all we're doing is shuffling the rate of return each year. And in the accumulation phase, it doesn't matter the order that the market goes up and down, you're ultimately going to end up with the same value in your portfolio in the accumulation phase, okay? Now, the problem is that once you transition from the accumulation to the distribution, you're going to see that things may not turn out so well. And if I hit the shuffle, there are some years that you may just flat out run out of money. You may have years, depending on when the market, when you retire, that you're going to be just fine. You're going to have more money than you thought. But you can also see that there's a pretty good chance that the market is going to, so basically the bottom line is that if you retire today going into a negative market, then you have got a much greater chance of your portfolio not lasting your lifetime than you do if you retired shortly after the bear market is over. Okay, so this is what we call sequence risk, and it's a real problem. So if I do a summary right here, just to get up the Word document, so you can see this. Again, starting at age 66, taking out 4%, you can see that the best year, the initial year to retire was 2017. The potential retirement income was $2.1 million, and the last age 92. The worst year to retire in that 20 years was 2006, and again, your retirement income only lasted until age 79. Okay, so all this is a mathematical example to show you the risks of what we call sequence risk. And when you guys retire, you're saying, hey, I want to retire at this age, and regardless of what the markets are doing. Well, my point is that by doing retirement planning, especially with me, then we can actually put together an income portfolio that can meet those income needs for the rest of your life. So regardless of what the markets do, that you're going to have enough money to live and also deal with market risk and longevity risk. Okay, so that's the main point I want to talk about. So this is one of the big negative points about taking the investment-centric approach to retirement, income, is that you're subject to sequence of return risk. Okay, so that's a super important, point I just want to make right there. Okay. The other thing I want to talk about is the difference between technical liquidity and true liquidity. Okay, so if you have your entire portfolio in your 401ks and your investments that you're managing or your advisor is managing, and it's all in investments, there's no annuities, there's no cash value life insurance, it's all in investments. That portfolio is technically liquid. There's no question about that. But an investment portfolio is a liquid asset, but some of its liquidity may be only an illusion. Again, some or even all of the investment portfolio may be earmarked to meet future lifestyle spending goals. This is called technical liquidity because technically the money is liquid, but you cannot freely spend it as you wish because you're not sure how long the market's going to, how long you're going to live and what the market's going to do. Again, we've had basically a bear market every 10 years. So true liquidity is when you have your basic expenses are covered by guaranteed sources of income such as Social Security, pension, or income annuities, leaving the remaining portion of your portfolio available to spend. So allocating a portion of your portfolio to generate guaranteed income to cover basic expenses frees the remaining money of your portfolio to spend how you wish, thus providing true liquidity. Okay? So retirees who take the probability-based approach manage market risk, sequence of return risk, longevity risk, rising healthcare cost risk by spending less in retirement or redirecting their spending from fund items such as basic expenses. Okay, so in contrast, the safety first advocates use the floor to generate guaranteed income to cover basic needs. So this approach is made up of 3 different types of annuities. Okay, the first annuity is the one you guys are familiar with, is called Social Security. Yes, Social Security is an annuity. A pension is an annuity. And what I'm talking about, so if you don't have a pension plan, the third type of annuity is actually generated from an insurance company, and that's what we call an income annuity. And so we actually use income annuities all the time to fill the gap between your monthly needs and what your Social Security and pensions are going to do. So again, just to reiterate, by using a portion of your portfolio to go into an income annuity to cover your basic expenses, that actually frees up the rest of your portfolio to actually to deal with spending shocks. But also, if the market is down as it is and you don't want to sell today to lock in losses, it gives you time for that, for your portfolio to kind of go back to where it was, so you don't have to sell. Okay, so the safety first approach is by far the best approach, and I firmly believe that. Okay, now again, this just summarize what I just said. By allocating a portion of your portfolio to cover basic income needs in retirement, the rest of the portfolio may be used to spend as you wish. As previously mentioned, this is what we call true liquidity. Okay. The third strategy is what I call the bucket strategy, where we basically divide your portfolio into 3 different buckets. We've got a short-term bucket between 0 and 3 years. That money literally is going to be in money markets and CDs, cash equivalents. Bucket 2 is going to be kind of a midterm between 4 and 10 years. That's going to be a sort of a balanced portfolio. It could be a 60-40, 50-50, or 40-60. But again, that's going to have a time frame of 4 to 10 years. And the third bucket is what we call your long-term money. So that's going to be 10 years plus. So you can be super aggressive in that as you want to, because the idea is that you're not going to touch that money when the markets drop like they are right now. Okay. So one of the best combinations you can do to actually have guaranteed retirement income is the combination of the flooring approach and the bucket strategy. So again, that's where we combine both insurance-based products and investments that are managed well and have specific purpose. It gives retirees the best chance to meet their retirement income needs and address many risks that we must address. So again, what you have to address, what we all have to address, is market risk, sequence risk, longevity risk, and ideally we want to have true liquidity in the portfolio as opposed to technical liquidity. And so what you also find that by using annuities in the portfolio, they actually require less capital to meet your objectives because they have higher payout rates than safe withdrawal rates, and therefore it takes less money to generate the same amount of income by using an annuity opposed to taking distribution from your investments. And again, I talked about that in my Social Security workshop in terms of safe withdrawal rates. So I mean, the average safe withdrawal rate is going to be about 2.5%, where I could get 5 to 6% safe withdrawal rate on an income annuity. So you know, one of the things is that your overall income plan should take into consideration the tax consequences, the RMDs, and also leaving a legacy, which is a whole different dimension that we talk about within overall retirement income planning. So again, my last section I'm going to talk about, I'm almost done, is that the bear markets present great opportunities. There is no better time to reevaluate your financial plan or your retirement plan and update your retirement plan projections than right now when the market is crashing. So again, you need to reevaluate your portfolio in both the asset allocation, a tax allocation. And again, what we do is that we actually say, well, how much of your portfolio should be in aggressive, moderate, or conservative accounts? Again, that's kind of where that bucket strategy comes into play. And the other thing is that now's the time to actually look at leveraging insurance products, okay? So everybody is so investment centric is that they don't even think about the insurance products as even on the radar. But what I'm telling you is that you need to have insurance products in your overall portfolio in order to optimize what you're trying to accomplish. So again, this is where we actually look at cash value life insurance, where we actually minimize the death benefit, maximize the cash value. We use that a lot in many different kind of planning situations. We look at annuities, long-term care, hybrid life and long-term care products, and so forth. So I just want you to kind of think about, it's kind of something for a moment before I get to the Roth IRA conversion. If you have to take money out for long-term care expenses, and by the way, I've got long-term care calculators, and let's say you have to take out $50,000 to $100,000 a year for long-term care per person, and the most of your portfolio is in qualified money that's never been taxed. So just remember that we keep on building these deficits, and most likely our taxes are going to go up. So that means that in the future, when you've got to pull out 100 grand out of your portfolio to pay for long-term care expenses, you're going to keep less in your pocket because you're paying more in taxes, because we've got to basically raise taxes just to be sustainable with our government. So my point is that by putting some money into insurance products, you're basically allocating that towards that future risk. And the reason why I bought a hybrid life / long-term care policy for me and my wife is that I've got both a life insurance need, I got a long-term care need. So if I die, my wife gets the benefit, and same thing, if she passes away, I get her tax-free death benefit. But in the more likely scenario that she and I need long-term care, money down the road, I've got a tax-free pool of money that I can pull from. And also, what it costs me to get to $500,000 of hybrid life and long-term care is roughly a third of that amount in premiums. So I'm leveraging my dollars by buying insurance that I'm going to leverage in the future. So again, I'm happy to talk to you guys about that at some point if you have some interest. But that's something that you need to be looking at, is all the different ways that you can not only make sure that your portfolio is positioned correctly, but also take advantage of the great strategies that we use with insurance products. And the last idea is in terms of the Roth IRA conversions. I talked about taxes going up in the future, and again, I just got to do this just because, again, some of you may not have seen this, but if I literally go to tax history, I go right here, come on, and let's say you've got a $1 billion portfolio, and you've got a 30% tax bracket, and again, you can see that you're going to keep roughly $700,000 in tax, and the IRS gets $300,000. And if you actually kind of show the events or all these kind of things, is that what happens is that the federal government not only raises the threshold for taxes, they also raise the tax rate. So if you go back here to 1931, the threshold for the highest tax bracket, which was only 25%, was $100,000. The very next year, 1932, they raised the top tax bracket to 63%, but they raised the threshold to $1 million. Fast forward to 1945, they lowered the threshold to $200,000, and the highest tax bracket was 94%. That was a cash grab because the federal government needed money. Fast forward to where we are in 2019 or 2020, is that again, the highest tax bracket is 37%, but the threshold is $622,050. So historically speaking, if you want to look at the average is 57.31%. Again, if you look at the debt clock, you can kind of see, I've shown this in all my seminars, we're looking at a national deficit of over 23 trillion. Our money right now is going to Medicare, Medicaid, Social Security, Defense, and War. And although interest rates are low, when the government's talking about giving stimulus and giving everybody money and loans, that's just going to add to our deficits. So my point is that if you feel that taxes are going to go up, now is the time to consider a Roth IRA conversion. Okay, and really what that is that when you do a Roth IRA conversion, you literally move X amount of dollars from an IRA to a Roth IRA. Once that money leaves the IRA account and goes to the Roth IRA account, that is now a taxable event, and a 1099 will be generated by your custodian. Fortunately, if you do that today in 2020, you don't have to pay that tax until 2021, a year from now. So basically, if you feel that taxes are going to go up in the future and the market has dropped and you want to transfer $10,000, that's basically $10,000 of taxable income that just adds to your taxes for 2020. Again, what's happening is that if your portfolio is the same in the traditional IRA and the Roth IRA, they're both going to go up at the same time. Just think about this. With the Roth IRA, you're paying tax on the seed and not the harvest. With your traditional IRA, you're paying tax, on the harvest and not the seed. And remember, the government created 401k plans back in the 70s because they wanted to make sure that they had access to your money and have a source of revenue. So the federal government wants you to put your money into qualified plans because that's ultimately where they're going to get a lot of their tax revenue. So fortunately, you know a guy like me who can talk to you about tax strategies and Roth IRA conversions and how to minimize the tax and keep more money in your pocket and also keep more money in your family in terms of leaving a legacy. So if you want to talk about Roth IRA conversions, we can certainly do that. Just send me an email, give me a call. So basically, that's kind of where we are with the presentation. I'll kind of open up for questions and answers. But I just want to thank you guys for coming, and you guys will get the copy of the presentation once I get it approved.